Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show, Victor.
Well, Jim, thank you for having me back.
Victor, before we get into specific markets, can we talk about how you trade? I know you have a macro view on what's going on, that you limit your trading to exchange-listed futures and options markets, but how do you decide what to buy or sell, when to take a position, and how do you manage risk? I think risk management is probably the biggest thing people are asking about right now.
Well, managing risk is absolutely the most important thing, but we could do this in 5 minutes or 5 days, I suppose. Let me kind of give you the short answer. I've been doing this for coming on 50 years, so I've developed some habits. I do read a lot of research and opinion pieces from all kinds of sources. I subscribe to a lot of stuff. I have a huge network of friends that I swap stuff with, swap ideas with. We'll email each other, talk to each other on the phone about what we think is going on in markets. I certainly look at a lot of charts as well. And not just say look at a chart of, for instance, the stock market, the S&P 500, but I'll look at charts of things that come to bear on the stock market. I ask a lot of questions, and kind of probably the key question is why. I'm looking at something and saying, gee, why is that happening? Why is that? I look at a lot of relationships. We can talk about this more when we get into stocks specifically, but the stock market is not a monolithic thing. Let's go there. Clearly, there's a whole bunch of stocks. I don't trade individual stocks. Maybe from really on rare occasions, I'll trade stock indices, but I'll tell you, there's a world of difference between the S&P 500 or the, say, even more dramatically, the NASDAQ 100 stock indices and the Russell 2000. It's about virtually night and day. So I'm going to look at a lot of different charts. Time frame is hugely important. You just kind of get to know what your time frame is. I do not enter an order. I don't get into the market with the idea of taking my trade off today. And yet sometimes I will. And almost every time that happens, it'll be a losing trade. I've thought, that I want to buy something and go, okay, this looks like a good spot, I'll buy it. And then as the day goes on, maybe the trade just never sees daylight and I'm thinking, I don't think this is working, and I'll kick it out. But generally my time frame is going to be, I'm putting on a position with the idea that I'm going to have it on for a minimum of a few days, maybe a few weeks or a few months. Beyond that, that's just too hazy, too far out there to really have a view on. I'm going to certainly look at the charts, not only to get information, but looking at the charts gives me some idea about where I might enter a trade. In other words, some of my favorite patterns, the market has had a run to the upside, and I'm thinking the market is maybe overvalued, but I don't short it. It keeps running to the upside, and then maybe it breaks and go, okay, that's interesting. If it rallies back and makes a lower high and then starts to fall, now I'm really interested. If I thought in the first place that it was a short, now I've got what I would call a failed top, and now I'm more willing to be to take a position. The flip side of that is I need to be patient and willing to not make a trade. If I can't find a good place to put the trade on, I just don't do it. And there's nothing worse, I think, and everybody that's traded for some time will know this, when you chase a market. Let's say you're bullish on a market and it's going to the upside, and finally say, God, I got to get into this thing. It's getting away on me. That's what they call FOMO, the fear of missing out. So you buy it, and, immediately it starts to set back. Well, you're underwater right away. You did not put the trade on in a good spot. This is an ugly position to find yourself in. So you got to be willing to not make a trade. And then in terms of managing risk, there's all kinds of ways to do that, but let's say, clearly, sizing. I'm not going to mortgage the house to put a trade on. For me, in my commodity trading accounts, and I do restrict my trading pretty much to what we call exchange traded futures and options. That's kind of what I've specialized in for the better part of 50 years. You can't be good at everything, so try to maybe be good at something and narrow it down. So that's what I trade. Sizing. I kind of do the sizing backwards. Let's say, just for a round number, you've got $100,000 in your account. I am willing probably to lose no more than 1% of my account size on any brainwave that I put on. So let's say I've got $1,000 to spend on this idea, or I've got $1,000 that I'm willing to risk before I see that I'm wrong. So now I need to find a spot where I can put on a trade, and the reasonable stop point, or the reasonable point where I'm going to know I'm wrong in the trade, is no more than $1,000 away. So there's that. So I always use stops, and the stops, I will move them for sure. When I put a trade on, I want to put a stop in the market just so that if, something stupid happens, something totally unexpected happens, I'm going to be taken out of the market, whether it happens when I'm sitting in front of the machine or overnight when I'm asleep or what have you. I want to have a stop in. I will probably quickly move my stop, and the stop is just kind of a worst case get me out deal. And if the market starts to go my way, I'll move my stop quickly, trying to get it down to a point where the worst that's going to happen is I have a break even on the trade. Concentration, a lot of the markets move similar to one another. Let's say just talk currencies, if I'm long already of the euro currency and I like the look of the Swiss franc and I want to buy that, well, it's actually the same trade in a lot of instances. So, now I'm doubling up concentration on one thing. And maybe in terms of risk control, you just need to be prepared to be wrong. I know over all these years I lose money on more than half of the trades I make. So when I put a trade on, if it turns out to be a loser, no big deal. Happens all the time. Just kind of got to, do it and then move on to the next thing. I would say in terms of being wrong, with the job that I have watched literally hundreds and hundreds of people lose millions and millions of dollars. My clients of brokers that worked around me, worked for me, what have you, and the thing they all had in common was when a trade wasn't working for them, they'd say, well, let's give it a couple more days or something. Nothing wrong with being wrong except staying wrong is my mantra on that one. It's just a trade. It's not your whole life. It's not a big deal. It's not working. Get out. Clear your mind, save your money, save your energy for finding a trade that is working. So, yeah, that's how I manage risk.
A friend asked me, how do you find a good financial advisor? And I think this is advice from you, is find somebody whose philosophy agrees with yours. So if you're an aggressive trader, you want somebody like that. If they're conservative, somebody who agrees with what your philosophy is. Otherwise, you're just going to be fighting with them all the time. Is that good advice?
I think the way I've said it, Jimmy, and that would be, when I used to speak at conferences a lot, and after you do a speech, there'd be some people come up and ask you questions, and they'd say, hey, how do I find a good broker? And I'd say, well, you just kind of got to ask around, go look, go shopping, as it were. But what you're looking for is somebody that you can get along with. I would say it doesn't need to be the sharpest tack in the box, really. But you want to find somebody you get along with, somebody that you think listens to you, understands what you're talking about, where you're coming from, what your objectives are, that sort of thing. And if that's not happening, you have to move on. And here's the other thing. That broker that you find, the first guy's probably not the right guy, unless you get really lucky. You may have to try one or two people. Just like going to restaurants, I suppose. If you find one you really like, you keep going back there. You find one that you don't like, you don't go back to it anymore.
We'll have more with Victor Adair right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Victor Adair. What are your thoughts on the stock market action right now?
Well, let's do it this way. We had a big rally from the lows in Christmas of 2018. Remember, we had that sharp sell-off, sort of October, November, December, and the market spun around and headed up, beginning at Christmas 2018. From there until the highs we had in February of this year, the market was up 45%. That's the S&P 500. And half of that gain came in the last 5 months. That was October of last year to February of this year. I will say that I thought the market was egregiously overextended at that point in time and was really at risk of an exogenous shock, and boy, did we ever get a big one in the form of the virus. I saw that virus as a catalyst that set the dominoes tumbling in a market that was dangerously at risk of getting hit by a catalyst, whatever the heck it was that came along. So then we've had this really sharp fall into the middle or late part of March, and since then we've had a bounce back in some of these indices of well more than 30%. At this point, my thinking is this bounce back off the March lows is a bear market rally. Bear market rallies can be astonishingly strong, as this has been. So my overall view, and here's the thing, you get a view, and I'm willing that my view might be dead wrong. But I think all of this stimulus that's been proposed from governments and central banks around the world does not equally offset the damage that's been done to this, let's call it the economy, to people's psyche, to the way we live our lives, and on and on and on. So I'm not expecting, that the stock market sort of, the coast clears, the virus is gone, and then we're off to the races again and making new highs and so on. Might happen, but I'm thinking that more likely the short-term environment is going to be an environment of deflation, despite all of this money and promises of money and whatnot that have come from what I call the authorities, the governments and the central banks. People have been trained since Greenspan, so that's more than 20 years ago, that the Fed would come in and fix things, would bail everybody out. So I think the damage that's happened here from the events to the economy, massive unemployment, job losses, businesses shutting down, everybody knows that stuff. I think that is greater than the fix. I think that the fix, as it were, kept us from having a horrible disaster. Okay, kind of level things out to some degree, but I think that the pressure is still on the downside. So, as I was just saying moments ago, that the stock markets are not monolithic. I mean, I pay really close attention to inter-market relationships. And everybody, I guess, these days knows there's about 5 big tech stocks that are a huge 20% part of the S&P here in terms of the amount of firepower that's taken that market higher. I mean, I'll look at the emerging market stock indices. They're up about 30%, where the NASDAQ 100 is up about 80% from the recovery, that is, of the break that they had into the lows of March. So, yeah, I'm trading the stock market from the short side right now. Now, I caught a chunk of the rally, the break, I should say, February into March. I caught part of the rally up from the lows. I get bits of this. You never get, in at the top and out at the bottom. Just doesn't happen. But for the past 2 weeks or so, I've been thinking, okay, this rally off the lows, running out of steam. I'm looking for spots to get short. I've been short a couple of times, lost some money, got out quick. I've also had caught a good leg from last week's highs into this week's lows, and I'm back on the short side again. With again monitoring my size in terms of how much risk I'm going to take, and I also know where I'll get out if the market carries on to the upside.
Do you think we'll see negative interest rates in Canada and the U.S.?
The Bank of Canada and the Federal Reserve, I think, have kind of made it clear that their present thinking is no. And I think really the experience that the central bank types will share with one another, that the people from Europe are probably saying to their colleagues around the rest of the world. This is just me imagining this stuff, okay? But, this is kind of what I think. They're thinking that, negative interest rates really weren't such a good idea, and if we had to do it over again, we wouldn't have done that. Now we have a problem is to try to get ourselves out from that. I think what the central banks here would rather do, instead of going negative, is they'd rather just push more money into the system. In terms of interest rates, in a way, the bond market is broken. I mean, we've had the United States Treasury tell us here that they are going to auction $3 trillion worth of securities over the next few months, and the bond market hardly moved. So if when I say the market's broken, then you can't kind of rely on the signals you're getting from it. Now, some people would probably kick me for saying that, say I don't know what I'm talking about, but this is just, my view here. It seems as though where we've come to this, MMT, a modern monetary theory point in our lives, where, yield curve control is already in place. You can't short the bonds because you have this fear that, the Fed will just come in and buy another trillion. Well, you don't want to be on the opposite side of their trades. But we've had a 40-year bull market in bond prices. Interest rates have fallen for that period of time. We're at the lowest interest rates maybe ever as far as, modern history is concerned. Certainly lowest interest rates in hundreds of years. And there's different kinds of interest rates. There's nominal interest rates, and then there's real rates. And we've had negative real interest rates, where the coupon, let's say it's 1% and inflation is 2%, then you've got negative interest rates, negative real rates of 1%. But if we're in a deflationary environment, and the central banks won't let the nominal rate go below zero, but let's say the CPI is running at negative 2%, then we've got rising real rates. You have that in a deflationary environment. So when you ask about, interest rates, there's all kinds of different interest rates. Certainly there is the fear of quality. Everything gets marked off the treasuries. The poorer quality paper, really took I just about said a wrong word there for radio. Really took a beating, in the early part of March when they were throwing the baby out with the bathwater. And one of the programs the Fed had, they decided that they would come in and they would buy corporate bonds. They're going to do whatever it takes, to keep the market from tanking. So to answer your question, short and sweet, I think at this point in time, the central banks in the United States and Canada would rather just push more money into the system rather than issue a bond with a negative interest rate.
We'll have more with Victor Adair right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, do you think the U.S. dollar goes higher or lower from here?
Jimmy, just before I answer that, I got to say, I just said in that previous part that the central banks wouldn't want to issue a bond with negative interest rates. The central banks obviously don't issue bonds, but that they don't want to take interest rates below zero. The U.S. dollar, I mean, it's been, again, we see the U.S. dollar in Canada. We see it against the Canadian dollar. A lot of people in the world look at a U.S. dollar index, which includes largely the euro, the Japanese yen, and a couple of other currencies like Canada and Switzerland. But then there is other currencies in the world. And the U.S. dollar has been really strong against emerging market currencies. You talk about Brazil, Turkey, certainly things like, Venezuela, Iran, off the charts weak. So I refer to this as the stealth strength of the U.S. dollar. Yes, the U.S. dollar has generally been trending higher for nearly 10 years. Certainly since 2014, and certainly the last 2 years, the U.S. dollar has been going up against most all other currencies. And, you've heard me say it once, you'll hear me say it again. I've been saying it for 30 years. That capital comes to the United States for safety and opportunity. When the market gets scared to death, the U.S. Capital markets look like a pretty safe place to be. Or that would be Americans that have invested in some country you couldn't find on a map decide maybe they better bring that money home. The Japanese certainly do that. You see the Japanese currency gets bid when there's stress in the markets, and that's capital either leaving Japan or coming back to Japan. But the U.S. dollar, where do I think it goes from here? I got to tell you, that's a bit of a coin toss. I mean, I've been trading the Canadian dollar, expecting it to weaken. I haven't done a lot with other currencies against the U.S. dollar, say in the last month or so. And it has been wickedly choppy, since things got dramatic here as we got to mid-February to now, so the last 3 months. I hear arguments that, it's going to go to the moon, and because, particularly against emerging markets, because they're so indebted in U.S. dollars and they haven't got the wherewithal to pay that money back, so their currencies will really go in the tank. Jimmy, I don't have a real big opinion on where it goes from here other than, I'm certainly watching it and I don't mind taking a position, but I don't really have anything on right now.
What about the Canadian dollar? It's gone down from 77 cents at the start of the year, down between 69 and 72. Where does it go? With Canada, we've talked this. Let me highlight this. There's basically three things that determine the value of the Canadian dollar relative to the U.S. dollar, which is where we mostly see it. And one is how the U.S. dollar is doing against most currencies in the world. And if the U.S. dollar is mostly going up against other currencies, it's going up against the Canadian dollar. The interest rate differential between Canada and the United States sometimes is really important. Most of the time it's just sort of important. Sometimes it doesn't matter much. And the third thing is commodities, and especially oil. And then from time to time, other things, whether there's politics involved, let's say, not politics, but, if some of the rating agencies downgraded Canadian debt, that would be important to the value of the Canadian dollar.
If the markets, the people that are trading in the markets, trading the Canadian dollar, got fixated on, the huge amount of consumer debt that we have here, or everybody was nervous about housing prices, that would be something else that comes in. The day-to-day lately, the Canadian dollar has been kind of moving in harmony with the stock market, or more generally, if the market is feeling risk on, the stock market's going up, Canadian dollar is going up. Flip side, the Canadian dollar is going down. And it's been, the Canada has been paying much more attention then to, say, the ups and downs of the S&P than it has been to crude oil. Crude oil had this dramatic tumble. Canada certainly weakened on that, but the bottom didn't fall out of the Canadian dollar like it fell out of the crude oil market. So, as I said moments ago, the U.S. dollar has been trending higher for the last 10 years, and it's certainly been trending higher the last 2 years. Canada's just the other side of that. 10 years ago, Canada was at par. Now we're just above 70 cents. So Canada has been trending lower. One of my main trades, I guess, for the last 10 years and more is I've been trading the Canadian dollar to weaken, and I haven't really changed my mind on that in that kind of a time frame. And Jimmy, actually, we just mentioning that, I should say a word or two about crude. We had a really dramatic thing happen in crude oil where the Chicago Mercantile Exchange allowed the front month May contract to trade at negative prices. Everybody knew that it was a bad story with crude oil on the supply-demand side. The virus shutdown killed demand, as well as Saudi and Russia having a bit of a fight, and both of them agreeing to pump more supply. So we got into a situation where, roughly speaking, supply was 100 million barrels a day, and demand looked like it was 65, 70 million barrels a day. So, and then the existential problem became, well, what do you do when you run out of storage? And it seemed as though we were close to that, even with boats being used to store things. After a while, we're going to be putting crude oil in pots and pans or something. It just became this existential problem. So we had the May crude trade $40 negative. And I think it may happen that, and it may be happening already, but maybe in the future, that this will be seen as like the Lehman moment was seen back in 2008 when Lehman failed. And all of a sudden, it was a Minsky moment, okay? Like all of a sudden, people realized there is way more risk in the market than they previously thought. My whole career, I thought that physical commodities, physically delivered commodities like crude oil, like a bar of copper, what have you, a bar of gold, bag of wheat, that the absolute floor price was zero. And, you have your risk measuring models, and they're based on zero is as low as they can go. Everybody knows if you're short something, you've got unlimited risk, theoretically, that the price could just go up and up and up, and there's no limit to how far up it could go. But if you buy something, the worst could happen, it goes to zero. Well, all of a sudden, the worst that could happen is way worse than zero. So, that just was such a weird thing to have that happen. And, we had implied volatility on the options market in crude go north of 200%. Just absolutely off the charts. And we have brokers who have just restricted clients from being able to trade anything to do with, the nearby months in crude oil. And then, of course, we've got the whole farce that was the oil ETF, USO, where people who had no idea what the hell they were doing really, thought that they were bottom picking the oil price and it couldn't go any lower, and it just became a disaster. So oil has been wicked in terms of exposing people to risk that they had no idea that they were taking. It's still a hell of a problem. They're still pumping more crude, it seems, than is being used. I have seen the oil share prices of some companies turn around and rally, and of course, we've seen crude oil prices on the deferred months have traded up from the lows they got into a couple of weeks ago when we had May go minus 40. I have a thought on that, and that is, Trump likes to style himself as tariff man. He can put tariffs on another country without getting the backing from Congress. He can do it all by himself on the grounds of national security. We're in an election year. There's November this year, the presidential election. I would absolutely not be surprised if Trump was to say something like this. On the grounds of national security, we need to protect and maintain our domestic oil business so that we are energy independent. We're not dependent on somebody on the opposite side of the world sending us fuel so that we can survive. So therefore, we're going to block or put tariffs on any oil coming into this country. And, I don't know what that would mean, but maybe suddenly WTI is at $50 and the domestic industry can carry on. Who knows? We've been through the looking glass here already with crude oil, and to say that something that would seem so out of this world could happen to crude oil, that's it. Yeah, I think that we could really see some weird stuff happen there.
Gold made an 8-year high at around $1,780 a month ago. It's down about $100. What do you think's going to happen to gold given all these billions and even trillions of dollars of government stimulus being shot around?
The stock market was wicked. Crude oil was wicked. Gold had some pretty wicked price action as well. I think we had 10 consecutive weeks. I remember sorting this out when I was looking on the charts, where the gold price had a range. Now, this is gold traded in the futures market, traded 24 hours a day, had a range of over $100 in a week for 10 consecutive weeks. Gold got clubbed in early to mid-March. I think, the prices come down certainly well over $200, maybe $250. I'm just rough figures at this moment. And it was, I think gold was being sold, maybe not by people themselves, but maybe by their brokers, their margin clerks, where people were needing liquidity, sell what you can, not what you want to. And then when the Fed came in big, really big, around the 23rd of March, and basically said, we're going to do unbelievable stuff here, whatever it takes to stop this thing in its tracks. In the next couple of weeks, gold rallied $300, and we got up to a new 8-year high. I think a lot of the fuel that ran the gold price up $300 in 2 weeks was the idea that all of this money printing, to use that term, this stimulus, was going to be super inflationary. And therefore, gold was going to go to the moon. I think that got overdone, honestly. I said earlier, I think the deflation is more likely what's going to prevail here in the short term. Two of the biggest buyers in the world are India and China, and I'm going to say I think they're going to buy less gold, maybe a lot less gold in this deflationary environment than they have previously. And then, of course, millennials don't buy gold, by and large. It's older folks that, remember and buy gold. Now, and then there may be some countries selling. And the one that occurs to me is Russia. Their currency is under pressure. They really, their earnings from selling oil were really important. Maybe, I'm just guessing, that they might reduce the buying that they've been doing. They might even turn sellers, who knows. But I think we're in this deflationary environment short term, and the $300 run up in gold off the lows to 8-year highs got overdone. I've been trading gold from the short side, and I know there's folks out there that are, almost religious about gold and all that, and so I'm a heretic to say that, but, I'm just trading price action. I can see, by the way, just to let you know, I'm also on your side. I could see that, in the next couple of years, maybe gold prices are a lot higher. But right in through here, I think that $300 run up went too far, too fast, and prices are now down about $100, I think, from those highs, and the market still looks a little soft to me.
The broad commodity markets have been falling relative to the major stock markets for the past several years. Will that ever change?
Yeah, well, commodity cycles, I guess if you look back like over 100 years and more, commodities just generally keep getting cheaper. As the technology gets better to dig commodities out of the ground, or, the technology to how much corn you can harvest on an acre of land keeps increasing, so there's those supply pressures, or efficiency pressures keep making commodities cheaper, and then of course commodities, but it's short term, okay? We've seen, commodities are, the indices I should say, are heavily weighted to oil, most of them. So oil's getting clobbered, so that pulls it down. We've certainly been in a bear market in commodities for about the last 10 years. 2011, 2012 was kind of the last sort of cycle high. The grains right now, they're under pressure. The thought might be that China isn't going to be there demanding the grains that the market might have thought that they were going to want to take. But then there's an old saying on the commodity market, and that is that low prices are the best fertilizer for next year's crops. And that what that means is that if prices are so low now, it kills production, and maybe production is really damaged. And then we have shortages next year, and that drives prices up because it takes a while to, get that production ramped back up again. So maybe things are as bad as they're going to get on commodities. I think there's the number of reasons you could say commodities go in these cycles, and, it's been down for 10 years. It's probably going to turn. Yeah, I think that could happen sometime in the next couple of years, and it might really come from shortages, as much as rather than demand driving it higher.
So before we wrap up, any final thoughts on what's going on out there? What's going on? Yeah,
okay, Jimmy, I'm glad you asked. I've got one word for you, and that's transition. I think, in a way, this virus that came along and the knock-on effects from that this may actually be like a secular turning point in a lot of things, just how we interact socially. One word that comes to mind is de-globalization. I think that's really likely to happen, that we've been exposed, or I should say these extended supply chains we have around the world have been exposed as being really vulnerable, and people will make moves to tighten that up. One of the ways I see that, by the way, is what I call Fortress North America, and that would be that there would be this is that looking glass stuff, but really, Canada, the United States, and Mexico as a unit don't need the rest of the world for a lot. And I see that as a kind of a, people go, yeah, instead of those supply chains all over the world, maybe we could keep it here in the continent. And certainly not for everything, but I think there might be some of that. And then the other transition is this modern monetary theory. This question about when the politicians, especially the socialists, are promising they're going to do this, that, and the other thing, and some guy stands up and says, well, how are you going to pay for all that? Well, under MMT, it seems that, that question doesn't matter anymore. So, that's a hell of a transition, because we've always been conditioned to say, well, how are you going to pay for that? Now, whether MMT is goofy or whether or not it really happens, I don't know, but there's, as I say, transition is the one word. I think a lot of things have changed here or will change going forward because of going through this. But maybe one last thing, and that would be, let me ask this question. Given all of this, in some respects, draconian lockdowns, stay in your home stuff, issues, that you've been, people have been dealt with from the authorities, I wonder, will people in the future be that much more inclined to knuckle under, to what the government says or the authorities say, or will they rebel? And I'll tell you, that one of the key things, you asked me earlier about interest rates, if people lose confidence in the government, in other words, they say, the hell with you, I'm not going to do what you tell me, that would be a real transition, and that would just change the equation about whether or not interest rates can go higher or lower. Because at that point, if the governments are spending money like a drunken sailor and they're having to, print debt to get away with it, and people say, I don't want to own that paper, well, then we have interest rates go up, and maybe at the same time, stock markets go up because you want to own something that's real. I think what we're going through here may be a very uncomfortable, but a very major transition in a lot of ways.
Victor, thank you so much for chatting with us.
Jimmy, I probably got a little carried away, and some people might think I'm crazy, but yes, thank you. It's been a pleasure talking to you. I look forward to talking to you again.
My guest has been Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager of PI Financial in Vancouver. His website, polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @Housestreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of House Street Media Incorporated.